Welcome to this video on tick charts as opposed to minute charts for your day trading. So are tick charts better for day trading than time-based bars? Well, here are some answers for you. There's actually advantages and disadvantages to each. So let's begin with the advantages of tick charts. And actually, I tend to prefer them. So I'll show you why, but I'll also be very an advocate for the other side of the equation as well, and some of the advantages of time-based bars, such as minute bars. Okay, so number one, let's talk about the difference. What are tick charts? Tick charts are bars where the number that you put in, let's say you create a 1,000 tick chart. So each bar represents 1,000 trades. So in this context, a tick is a trade, regardless of volume. Just how many trades go through the market. As opposed to this chart here, where we have a 2-minute chart, and that means that each bar lasts for 2 minutes. So it's based on time. Each bar will last a certain amount of time. On tick charts, each bar lasts a certain number of trades. So you cannot say there's an equivalent of any tick chart to any minute chart because they're just completely calculated on different methods. All right, so the advantages of tick charts. One of them is that you generally get a more narrow range at swing highs and swing lows. And the benefit of that is that you typically have a smaller risk on your trades. You're risking less money. And that's a huge advantage. And that's one of the primary reasons that I use them. So let me demonstrate this to you to show you exactly what I mean. Bring up a ruler here. And I'll just take an example. Let's say that you're going to go ahead and trade this short for whatever reason, just showing you the a difference here. So we've got a 1.75. So if we said we're going to put our entry 1 tick below the low of that bar and our stop 1 tick above the high of that bar, that means we'd be risking 2.25 points. And all right, so 2.25 points would be our risk. Now let's compare that with a tick. Let's leave that on there. We can just change this over to a tick chart real quickly here. Just go up here, select ticks. I'll put in 1,000, which is, about as close to equivalent as you're going to get. So here is the exact same spot on a 1,000 tick chart, where each bar represents 1,000 trades. So the same high, but what we can do now is we can move our entry below the low of that bar there. And so now the range there is only 1.25 points, which means that, again, if we put our protective stop 1 tick above, enter 1 tick below, then we're at 1.75. And so we just saved ourselves 2 ticks. Even more pronounced when you get a lot of volume that comes in at swing highs and swing lows. And the reason for that is that when you get a lot of volume, such as here, these volume spikes, then a tick chart will create more bars because you get a lot of trades coming through. And so every time 1,000 trades come through, creates another bar. Another 1,000 trades creates another bar. But on minute-based bars, you don't. It's going to stay there for 2 minutes no matter how many trades come through. And you end up getting wider range bars. And therefore, you end up having to risk more money on each of your trades. So that's benefit number one, and it is a huge benefit. It goes along with one of the cardinal rules of trading, keeping your losses small and letting your winners run. So this is the keeping your losses small part of it. So benefit number two is that for the exact same reason that it tends to create more bars as volume comes in. By the way, the converse of that is also true. The opposite of that is also true in that it creates fewer bars when less volume comes in. So there's 2 benefits to that. Number one is that when you get a lot of volume coming in, it creates less choppy markets. You tend to get these more sine wave type wave patterns. Very nice. And fewer real extreme spikes, real steep angles. You don't get as many steep angles because that is offset by the market creating or the chart creating more bars that go horizontally across. And so it creates more of a nice sine wave type pattern, more orderly pattern that I find easier to trade those patterns. And so that is a second benefit. And the opposite of that then, the flip side of that coin, if you will, is that when you don't get a lot of volume coming in, you don't get a lot of action going on, then it creates fewer bars. So you don't get as much consolidation where the market just goes nowhere. It creates fewer bars, and so the bars kind of hang there and hang there and hang there and wait till more volume, more action, more velocity, more orders come into the market. And so both of those create more nice, orderly sine wave type charting patterns. Okay, those are the advantages. Now let's switch over to the disadvantages of tick charts and the advantages of time-based bars. In other words, minute increment bars, whatever minute you're going to measure. So before we move over to the minute bars, let's look at this here real quick so I can show you. If you look at volume here on the tick charts, look at that. It's all pretty even. It's all fairly even. You don't get a lot of major moves up and down. You don't get real clear patterns on it. And so it all just kind of hangs up here. And again, it's for the exact same reason that I just mentioned. So if you rely on volume a lot for your trading, tick charts are not as good for you. They're not as good for that reason. So let's go over to a time-based chart and show you what the difference is there. This is the exact same chart, but on a 2-minute bar. So you see it comes up. First of all, we get a nice big volume spike there. And then we get moving up, moving down, see much more clear volume patterns. Very low volume. See, we never saw any situation where we had very low volume on the tick bars, but here we do. And that is, very helpful in certain situations. That's important to you. And yeah, we've got it right there, very low volume. And then spiking back up. Much more differences. We get these volume spike bars. So if you like volume, then you definitely are going to want to trade time-based bars. Another benefit of time-based bars is if you rely on candlesticks a lot. Time-based bars create better candlestick patterns. And part of the reason for that is, again, tick bars create not only more evenly leveled volume patterns, but also they don't create the real wide range bars as much as time-based bars do. But candlesticks, one of the ways to read candlesticks is to look for those wide range bars. Those give some nice, very nice patterns, and it's part of reading candlesticks. So on candlestick bars, on time-based bars, you're going to get narrow range bars, and then you're going to get real wide range bars. So again, the disadvantage of that is, well, you're risking more on the trade, on the swing highs and swing lows. But if you rely on those candlestick patterns, you're going to get better candlestick patterns on time-based bars. All right, so if you have a timer on your charts, such as this one right here, it's not actually moving right now, and that's a function of me using a screen capture here. But this would normally be counting down. So on time-based bars, it'll count down every second, go from a minute 26, a minute 25, a minute 24, and every second that will time down. And so then you can watch it, and as it gets close to zero, you know when the next bar is going to form. And that's always going to be very accurate, and so it allows you to time your entries. If you're looking to enter on the next bar, then you can time your entries with perfection and precision. Tick bars, not so much. You can still use the timer, but it will count down the ticks. Well, the timing of the ticks is dependent on when those trades come through. It's not set to a clock. So when orders slow down, there could be a few seconds where the tick count doesn't even change because no orders are coming through for a little while. And then all of a sudden, you could get a flush of orders, and it could go from a countdown to, let's say the countdown is at 50 ticks, 49, 48, then it could skip to 40, and then it could skip all the way down to 0, and then the next bar forms. And that's because a flood of orders came in all within 1 second, and that means you can't time your entries as precisely as you can with minute bars. So which one is better? Neither one is better. It's just a matter of which one fits your personal preferences for the way that you trade. And just be aware that there's pluses and minuses, and choose the ones that are important to you. So if you like this video, please understand that it's really not free. If you got value from this, then you have an obligation to pay it forward by clicking the share button below. Please do that. That really helps. In addition, if you're watching on YouTube, please click the thumbs up icon and leave a comment, because your comments really encourage me to create more free tutorials for you, which I enjoy doing. I've got a special offer right now. I'm giving away one of my favorite trade strategies called the rubber band trade. It has a very, very high win-loss ratio, and I'm going to give it to you for free. It's a simple trade. I'll teach it to you in about 26 short minutes. So to get the rubber band trade strategy absolutely free, just click on the image in the top left corner, or if you're on a mobile device, then click on the little eye with a circle around it in the top right corner of this video. And if you're not watching on YouTube, then there's probably a link below or an opt-in form on the side. Once you do that, I'll personally email the video to you with the rubber band trade strategy.